Kevin Gordon joins us alongside Cooper Howard. Time for a big picture discussion. Kevin's a senior investment strategist and Cooper's director and a fixed income strategist at the Schwab Center for Financial Research. We got Mr. Gordon on the line. Kevin, get us started for stocks. S&P 500 is sitting right at 61. Does this look like the breakout to you?
It's certainly a better day than yesterday, even though you had a pretty solid gain. Breadth was, decisively weaker than the day before. So, I'd rather take a day like today where even though you're not getting as much of a lift from the mega caps, you could argue it's better because the so-called rest of the market is, doing more of the heavy lifting. But that's, been a key area to watch from our standpoint of assessing this bounce, after we've gone through this, I would call it mini correction, because we certainly didn't get close to the, the 10% drop level from early December. But, given the swift nature of this rebound, relatively swift nature, the key is seeing how many members in the S&P can actually get above, these key moving averages, whether it's 50-day or 200-day. I think you still have to check the box on both of those. But assuming you get a relatively healthy close today, then you probably start to see, some healing in some of those metrics.
All right, we're checking boxes, trying to at least, seems like at least one of those boxes is getting checked. Price action wise, participation advance decline looking pretty good the last week too, so I think we're checking that one. Cooper, what about for bonds? Are we checking boxes too? Because it seems like it's all quiet on the Treasury front, no matter what kind of weird stuff the president's saying.
The box that you could check on the Treasury front this week is the snooze box. We obviously got Monday off. There were no major data releases throughout most of the week. You got jobless claims and continuing claims today, which I think still showed that the labor market continues to be a point of relatively somewhat of a strength, if you will. It's not deteriorating significantly. So there really wasn't any major catalyst that we saw in the fixed income markets, obviously, this week, Oliver.
So what about, Cooper, obviously I got to get your take. When the president says he's going to bring rates lower immediately, what does that mean to you?
He can jawbone as much as he wants, but I think that that's a very difficult thing to portray and to try to do. Obviously, the president does have a lot of influence. We don't want to dispel that, but the market is a global economy or a global market, and it moves different ways. So the Fed is going to be likely very data dependent. Our expectation on that is the president could lean against the Fed a little bit, but we think that what we've heard from Chairman Powell in the past is he very much values that Fed independence. So I believe that they're going to move rates based off of where they see the data incoming. It's likely that they're not going to cut interest rates for the first or potentially even the second quarter this year. The market's pared back a little bit in terms of what expectations are. We've also seen the 10-year Treasury pull back a little bit. So there has been some of a decline. I don't think that that's because of what President Trump has said. I think that's more closely related to what's happening with the term premium, Oliver. Now, the term premium is kind of this wonky thing that us fixed income folks like to follow and like to watch. And it's really just the compensation for holding long-term investments rather than rolling over short-term treasuries. So that's moved back down. And I think that that's really the reason why we've seen yields move lower recently.
Nice. All right. Great response. Great answer. Okay. So with the box checked for snooze on bonds, Kevin, I guess that means that with the price action we're seeing, we're looking for earnings to deliver next week. That's the next thing on the item.
Yeah, and I wouldn't be as focused on the actual results. Not only are they backward looking, which is always the case with earnings season, but now that we have the results of the election and we have the new administration, and given we're starting to get some sort of a flow of policy, albeit more on the immigration front, less on the tariff front, I think it's much more important to see what companies say in their guidance for the year. Whether you're going to get some actual meat on the bones when it comes to this narrative around some big CapEx cycle coming, and then subsequently, I think what happens with labor. And that, to me, I think the labor component is the most important because, you're in this really interesting, I think, good spot for labor where it's low hiring, low firing. But if you have any sort of damage to margins, regardless of what it's driven by, I think if you have any damage to margins for companies, then it's probably easier for them to let labor go, meaning you can have, a little bit more of a pickup and some upward momentum in the unemployment rate. Of course, that's not what we're seeing right now, but that to me, I think becomes a really important part of the story, whether there are maybe conflicting narratives around, really big CapEx spend, but maybe not as much confidence around the labor market. I'm, paying most attention to the commentary that companies provide in that context.
Great stuff. All right, so we'll pair it with some of the jobs data, as it was pretty light this week other than jobless claims noted on labor force and any commentary from the CEOs. Thanks a lot, gentlemen. Great to see handsome Cooper Howard face. Wish I could see Mr. Gordon, but nice to hear the soothing tones. Appreciate it, guys.